Okay, guys, we are going to start with our chapter 3. We're going to continue on with job order costing. Are y'all good with that? And I'm going to stop my video in case I kind of have to breathe. Sorry, guys. Oh. Okay. You know what is the toughest, and a lot of you in here wear glasses. Don't the glasses, aren't they the hardest? They're always getting fogged up. Okay, so we're going to continue on with this job order costing that we discussed last week. So a couple terms. Job order costing. A costing system used in situations where many different products, jobs, or services are produced each period, and you want to keep track of them individually. Absorption costing is a costing method that includes all manufacturing cost, direct materials, direct labor, and both variable and fixed manufacturing overhead in the cost of a product. Not bother, both. Okay. Job order, keeping track of specific products because a lot are being made. Absorption, the costing method that includes all the manufacturing costs, direct materials, direct labor, variable and fixed, to add to the cost of the product. All these are familiar to you guys. We're just really defining them. Allocation base is a measure of activity such as direct labor hours or machine hours that's used to assign cost to cost objects. Predetermined overhead rate, the rate we use to charge manufacturing overhead to jobs that we establish in advance each period. We determine it by estimated manufacturing overhead costs divided by estimated total amount of the allocation base. Overhead application. The process of assigning overhead cost to specific jobs using this formula. Overhead applied to a particular job is going to be equal to the predetermined overhead rate times the amount of the allocation base incurred by the job. Normal costing is a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by a job. And the job cost sheet is that form where we record all costs on a job. It shows the job number, direct materials, direct labor, and the manufacturing overhead that gets applied to the job. Okay. So we're going to start with understanding, again, these job order system. And this time around, we're going to start working on the journal entries. So we know raw materials are all the actual materials, products that go into the final product we're making. Work in process are the units of production that are only partially complete, but there needs to be more work before they go into finished goods. Finished goods are goods that are ready to be sold but haven't been sold yet. Okay? And then cost of goods manufactured are the manufacturing costs associated with the goods that got finished during this period. Okay? It's a lot of definitions. It's a whole new language. So we know that we've got raw materials, direct labor, and manufacturing overhead that get put into a product. On the balance sheet is where you're going to see your inventory. Remember, inventory is a current asset, and it consists of raw materials, and then there's a big area that's called work in process. The work in process area is when materials get taken out of the raw material inventory to start making a product. So that work in process will include, of course, raw materials, plus it will always include direct labor and manufacturing overhead. It stays there in work in process until it is completed. Then we have an inventory item called finished goods. The finished goods will be an asset until someone finally buys them. Once the finished goods are bought, they're going to be removed from the inventory asset account and transferred over to the income statement, basically an expense, cost of goods sold. So this shows you the big picture of kind of what we're going through, what we're doing, and how it fits into the different financial statements. Know that selling and administrative costs are never part of the product. They always go straight to the income statement. But what makes manufacturing managerial accounting so interesting and a little more, nuts and bolts, is because we really keep this as an asset until we sell it. And that asset inventory has various components of inventory until it is sold. Okay? To illustrate the cost flows within a job order costing system, we will record Ruger Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions, and it only worked 2 jobs in April. So job A is a special minting of 1,000 gold medallions commemorating the invention of motion pictures. Was started during March and got completed in April. As of March 31st, job A had been assigned $30,000 in manufacturing costs, which corresponds with Ruger's work in process balance on April 1st, $30,000. Job B, so job A came into April with some costs. Job B, an order for 10,000 silver medallions commemorating the fall of the Berlin Wall, was started in April and was incomplete at the end of the month. Okay. So we're seeing the flow of the T accounts. We show raw materials and go into the work in process. Okay. We show indirect materials are part of manufacturing overhead, but the direct materials to the product come from the raw materials account and go into work in process. Any small indirect materials leave the raw materials account, but they go into the manufacturing overhead. So no, with raw materials, they can either go into work in process or manufacturing overhead. Purchase of raw materials. On April 1st, Ruger Corporation had $7,000 in raw materials on hand. During the month, the company purchased on account an additional $60,000 of raw materials. We would debit our inventory asset raw materials and credit our accounts payable. Okay? If you have questions, you stop me. During April, material requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. These raw materials included $50,000 of direct and $2,000 of indirect materials. The entry for number 2 records issuing the materials to the production departments. Do you see how the direct materials went right into work in process? The indirect materials went straight into manufacturing overhead. And we have to credit the raw materials. That's getting reduced because it's going into other inventory accounts. Okay. Now, how do we record labor? The direct labor goes right into work in process. The indirect labor gets placed into manufacturing overhead. In April, the employee time tickets, which provide hourly summaries of each employee's activities throughout the day, included $60,000 recorded for direct labor and $15,000 recorded for indirect labor. The following entry summarizes this. The direct labor goes into work in process. The indirect labor goes straight into manufacturing overhead, and our credit, salaries, and wages payable. Then you see the account, the salaries and wages payable, has a combination of direct and indirect labor. The work in process right now has a combination of direct materials and direct labor. And the manufacturing overhead right now that we've already discussed has the indirect materials and indirect labor. Other items will flow in here, but that's what we've discussed with you right now. These are actual costs, right? Now, assume, sorry that I keep switching it. Assume that Ruger Corporation incurred the following general factory costs during April. So these are indirect costs regarding the products we're making, but they're costs. Utilities, $21,000, rent, $16,000, and miscellaneous factory overhead, $3,000. So all of this totals $40,000. It all goes straight into the account manufacturing overhead. And we're assuming accounts payable, we could have paid cash for it, but right now we're just showing it as accounts payable. Now, you see, we've got this big pot of manufacturing overhead where we're putting our actual expenses. But what we process over to our work in process while we're in production is only the applied amount. You know, we've created this predetermined overhead rate. And so we're applying based on, you know, how our best estimates, what we're applying to the jobs. However, guys, the manufacturing overhead actual could be greater than the applied or could be less than the applied. We just don't know right now. If actual and applied are not equal, then at the end of the year, we'll create an adjustment. Okay? The biggest problem in manufacturing is we're trying to get a great estimate of what all this overhead is going to be, but we don't always know it specifically. So that's why we have to come up with a predetermined rate. Now, assume that Ruger's Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B for a total of 15,000 machine hours. So we're going to take 15,000 machine hours times $6 an hour and apply that to the two jobs. So we're going to show it going into work in process and being credited to manufacturing overhead. Okay? Non-manufacturing costs don't get assigned to individual jobs. They get expensed right to the income statement. Salary expense of employees in the marketing, selling, or administrative departments get expensed in the period it happens. And advertising is also expensed in the period it happens. So as you see here, when Ruger incurs $30,000 in selling and administrative salary costs, it just goes right to the income statement, salaries expense. Depreciation on office equipment, admin, not the factory, goes right to the income statement. Advertising goes right to the income statement. The items in for manufacturing is everything to help build the product and all those indirect costs related to the factory. So you see, once the job is complete, we take it out of the work in process and we transfer it to another inventory account called finished goods. Okay, those are truly the items we have manufactured during the period. Job A was completed during April, but job B wasn't completed during April. So job B still is in work in process, right? Thus, the following entry is what transfers the cost of job A from work in process into finished goods. So you see that journal entry, that finished goods is for job A. It's been completed, so it's out of work in process and it goes into finished goods. Because job B was not completed by the end of the month, its assigned costs stay in work in process and will carry over the next month or whenever they're completed. If a balance sheet would be prepared at the end of April, the cost accumulated thus far on job B would be $72,000. Because if we look back here somewhere in our, whatever we were adding, the work in process would have an ending balance there of $72,000. Okay. Now, sorry, I went too far. Now, what happens when you sell them, to sell the products? They will go then from the finished goods inventory account over to an income statement account, cost of goods sold. So our cost of goods sold will be credited from finished goods and goes into the income statement, cost of goods sold. For Ruger Corporation, we will assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total sales revenue of $225,000. Because 1,000 units were produced and the cost of the job from the cost job sheet was $158,000. The unit product cost is $158 per medallion. Following journal entry would record the sale. So $158 times 750 units, medallions, should show cost of goods sold of $118,500. Remember, we show the sales as what we're receiving for the medallions. Two journals entries happen when we're dealing with products. We have to remove the inventory, our cost of the inventory from the asset account, and we also have to report the sales at what we're selling the products for. Okay? So we are going to look at an example in our book so we can, sorry, my foot's, so we can go through this process. Hey guys, is it warmer outside? Like what was the temp when y'all came in? Cold. Honey, it's better than 22 below this morning when I was filling up my gas tank. I know. It was not, I rather this than cold than a bunch of snow though, for driving purposes. You know what I'm saying? So we're going to look at this exercise. The Polaris company uses a job order costing system. The following transactions occurred in October. So we are going to take these transactions and we are going to prepare journal entries. Okay? Just like we've gone through in the PowerPoint here. So we're going to start raw materials purchased on account, 210,000. Easy. We debit our raw materials and we credit our payable. Then we show raw materials were transferred to production, 178,000 of direct materials and $12,000 of indirect materials. We know the direct materials go straight to work in process The indirect materials go to manufacturing overhead. And the raw materials inventory is credited for it all. Okay. Next, accrued direct labor is 90,000 and indirect labor is 110. Direct labor goes right into work in process. Indirect labor goes right into manufacturing overhead. Depreciation on the factory equipment, 40,000. Goes right into manufacturing overhead. Okay. Other manufacturing overhead costs, 70,000. You see how manufacturing overhead's a big number. The company applies manufacturing overhead costs to production using a predetermined rate of $8 per machine hour. A total of 30,000 machine hours were used in October. So the 30,000 times $8 an hour, work in process, is debited 240,000, and we credit manufacturing overhead. That's how we're applying it to the various jobs. Jobs costing 520,000 according to their job cost sheets were completed during October and transferred to finished goods. Again, it goes from one inventory account over to another. Debit our finished goods and we credit our work in process. Then it says jobs that had cost 480,000 to complete according to their job cost sheets were shipped to customers during the month. These jobs were sold on account at 25% of cost. So 25% of cost means we sold them for 600,000. We take the cost, multiply it times 125%. We get the sales price. Since we sold those goods and transferred it, it goes to cost of goods sold now. We no longer have that inventory. We sold it. That's the whole purpose of this. Sell it. Okay? So those various journal entries we just did get posted to the different accounts. So do you see for this period, just the manufacturing overhead? We have all our actual costs. We show what we applied, but we kind of over applied here. Does that make sense? And then we can see that our work in process at the end of the month has 30,000 sitting in it. Let's look at another one. Guys, I wish I knew of a better way to learn this stuff than just problem after problem after problem, okay? Because then you get the different scenarios and it just clicks with you. Dillon Products manufactures various machined parts to customer specifications. The company uses a job order costing system and applies overhead costs to jobs on the basis of machine hours. At the beginning of the year, the company used a cost formula to estimate that it would incur $4,800,000 in manufacturing overhead costs at an actual level of 240,000 machine hours. The company spent the entire month of January working on a large order for 16,000 custom-made machined parts. The company had no work in process at the beginning of January, and here are the various costs that happened. Okay, so our job is to prepare the journal entries, prepare T accounts, and then a scenario. So the journal entries, purchased raw materials. We debit the materials, we credit the payable. When we transfer raw materials, they either go into work in process or manufacturing overhead based on if they're direct or indirect materials. We put our salaries, direct wages straight into work in process, indirect wages into manufacturing overhead. Our depreciation on equipment goes straight into manufacturing overhead. This must be other miscellaneous items that we were purchasing that go straight into manufacturing overhead. And then when we completed, let me just see what F says. F says manufacturing overhead cost was applied to production on the basis of 15,000 machine hours actually worked during the month. So we took our 15,000 machine hours and figured out 4,800,000 divided by 240,000 machine hours to come up with a per hour overhead rate that is went from work in process, went from manufacturing overhead applied over to work in process. Remember, the predetermined overhead rates, the 40,800,000 costs divided by our estimated machine hours. Then we prepare our T accounts. Do you see? We've got manufacturing overhead here, 120, 195, 253. So we under applied our manufacturing overhead in this scenario. And we see our work in process. The cost of the completed job is $592,000. We know that because if you add, I should have shown totals here, balances. 360, 592. Okay. So we transferred, because this is the only job we had. We transferred out of the inventory work in process into the inventory account now called finished goods. If 10,000 of the custom-made machine parts are shipped to the customer in February, how much of this job's cost will be included in cost of goods sold for February? We have our cost of the entire product, 592. If we manufactured 16,000 units, we know the cost per unit. If we only sold 10,000 units, then we know 10,000 at $37 per unit is how much will be transferred to cost of goods sold. Actually, guys, it's pretty straightforward. Now, we will prepare schedules of cost of goods manufactured, cost of goods sold, along with an income statement. Remember, the cost of goods sold and cost of goods manufactured are going to have three components here: the direct materials, the direct labor, and the factory manufacturing overhead. We will calculate the cost of raw materials and direct labor used in production and the amount of manufacturing overhead that was applied. The manufacturing cost associated with goods that were finished during the period. So again, the flow of materials. Raw material purchases get added to the inventory of raw materials. But when raw materials, the ending raw materials inventory is deducted to arrive at raw materials used in production. So basically what they're saying is you take all the raw materials available, but what's left in raw materials at the end of the period, obviously everything else got transferred to raw materials used in production. Okay. Then we've got, as items are removed from raw materials, they get placed into the manufacturing costs. So our materials get transferred into our manufacturing costs. Then we take direct labor that's used in production and manufacturing overhead to production, get added to direct materials to arrive at total manufacturing costs. Okay, so we've got our direct materials, our direct labor, and our applied manufacturing overhead give us our manufacturing costs. Then all of those total manufacturing costs get put into work in process. Okay, so you've got whatever was happening when you started the month, there's a work in process balance. You add all these to that work in process balance to show what's going on during the period. But then you have an ending work in process number. Well, the difference between what's happened during the period and the ending work in process number is basically what goods got manufactured. They're done. They're not in work in process anymore. They're out. The cost of goods manufactured is added to the beginning of finished goods inventory to arrive at cost of goods available for sale. Then the ending finished goods inventory is deducted from that figure to arrive at what's been sold. You see how we're just plugging them in. So guys, what do you think here? Beginning raw materials inventory was 32,000. During the month, 276,000 of raw materials were purchased. The count at the end of the month revealed that 28,000 of raw materials was still present. What is the cost of direct materials used? Excellent. So we start with 32, we add our 276. We see what's available. We show our ending inventory, and the rest have been moved to work in process, our materials used in production. Okay. How about this one? Direct materials used in production totaled 280,000. Direct labors 375 and 180 of manufacturing overhead was added to production for the month. What were the total manufacturing costs incurred for the month? Direct materials, direct labor, and our applied manufacturing overhead. Beginning work in process was 125,000. Manufacturing costs added to production for the month were 835,000. There were 200,000 of partially finished goods remaining in work in process inventory at the end of the month. What was the cost of goods manufactured during the month? So we will start by the beginning work in process plus the manufacturing cost that went in for the period, gives us our total work in process during the period. Take away the ending balance. That's going to show you what goods were manufactured during the period. Beginning finished goods inventory was 130. The cost of goods manufactured for the month was 760. And the ending finished goods inventory was 150. So what sold during the month? What got sold during the month, guys? So we start with our beginning finished goods. We add the cost of goods manufactured. That 890 less our ending inventory, because that didn't get sold, it's still in inventory, gives us our 740. Now, here we've got Mason Company, all this information. We are going to prepare the cost of goods manufactured, and we're going to assume all raw materials used in production were direct materials. Then we're going to prepare a cost of goods sold schedule. And we'll assume that the company's under or over applied overhead gets closed to cost of goods sold. So to prepare the cost of goods manufactured, we start with our beginning work in process inventory. We add to it the direct materials. The way we figure those direct materials, we take our beginning raw inventory, add our purchases, subtract the ending inventory of raw materials to get what got put into production. Then we have our direct labor. Then we have our applied manufacturing overhead. So we're sitting with 280,000 of manufacturing costs. If we know our ending inventory is 5,000, that means everything else was manufactured. 275. Yes? Good. How do we determine cost of goods sold? We have our beginning finished goods inventory. We add what got manufactured to have total available. Then we have our ending finished goods inventory balance to see what were the cost of goods sold. Now what we're learning is we're going to either add under applied or subtract over applied overhead. So if actual manufacturing overhead costs are 80, but we applied 90 to this job, we over applied it, right? So we're going to subtract that 10,000 from this cost. Make sense? If it was under applied, then we'd add it to the cost. since we over applied it here, we're going to subtract it. The income statement. It shows our sales. It shows our cost of goods sold, then our gross margin. We've got our selling and admin expenses to then give us our net operating income. So now we're going to figure out this underapplied or overapplied overhead cost. And we'll figure out how to prepare the journal entry to zero out the manufacturing overhead balance. Okay. So what the difference is between the overhead cost applied to work in process, but the actual overhead costs, we refer it to either overapplied or underapplied overhead. Underapplied happens when the amount of the overhead applied to jobs is less than the actual cost. And overapplied happens when the amounts we applied to costs is greater than the actual cost. We gave them way too more, so we're showing the costs were really greater than they were. Pair company's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. Co's predetermined overhead rate is $4 per direct labor hour. So we know we applied overhead at $4 times the actual hours of 170,000 direct labor hours, or 680,000 is what we applied. If the actual costs are greater than 680, then we underapplied it. If the actual manufacturing costs are over 680, we underapplied it. If they're under 680, we overapplied it. Make sense? So their actual overhead costs were only 650. So we had taken and applied 680, which means we've overapplied the manufacturing overhead cost by 30,000. So what do we do when we overapply it? We will have to create a journal entry to reduce those manufacturing overhead costs, or the cost of the goods. How about this one, guys? Tiger had manufacturing overhead costs of $1,210,000 and a predetermined overhead rate of $4 per machine hour. Tiger worked 290,000 machine hours. Tiger's manufacturing overhead is overapplied by 50 or 60 or underapplied by 50 or 60. You think A? Okay. So what we look at is the applied was 290,000 actual hours times $4 an hour. Okay. And the actual costs were 1,210,000. So we under applied this by 50,000. What we gave to the product was less than what the actual manufacturing overhead cost consisted of. Any remaining balance in the manufacturing overhead account, such as Pear's Company's 30,000, gets disposed in one of two ways. It can be closed out to cost of goods sold, or it can proportionately be closed between work in process, finished goods, and cost of goods sold. So we can prorate those various accounts. So in this case, since we over applied it, we have, excuse me, did we under apply it here? Yeah, we under applied it or over applied it. So we take that 30,000 we over applied in manufacturing overhead, and we reduce our cost of goods sold. So we're showing we really spent 30,000 less in costs than we did, or than we originally showed. Calculating the allocation of under applied or over applied between the three accounts. If we say that work in process is at 68, ending finished goods is at 204, and cost of goods sold is at 408, with a total of these being 680. We'll take each of these accounts and prorate it. So work in process will get 10% of our over applied. Ending finished goods inventory will get 30%, with cost of goods sold getting the bulk at 60%. So we could allocate that 30,000 over applied this way and proportionately show a reduction to work in process of 3, a reduction of finished goods of 9, and the reduction to cost of goods sold of 18. So if we go that route, we'll debit our manufacturing overhead to zero it out, and we will credit each of these accounts to asset accounts, inventory asset, and then our cost of goods sold will go down. Bless you. There are two methods of disposing the under and over applied overhead. We can just zero it out to cost of goods sold, or we can proratedly assign it to those various accounts. It makes sense, it's more accurate, it's more involved, but it definitely is more accurate to do. What effect will over applied overhead have on net income? Okay, so basically, if we over apply overhead, and then we had affected the overapplied overhead, net operating income will increase, correct, because we've shown too much of an expense. Now, Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. This predetermined rate was based on a cost formula that estimates $218,400 of total manufacturing overhead for an estimated activity level of 12,000 direct labor hours. The company actually incurred $215,000 of manufacturing overhead and 11,500 direct labor hours during the period. Determine the amount of underapplied or overapplied manufacturing overhead during the period, and assume that the company's under or over applied threshold overhead gets close to cost of goods sold. What would the journal entry be to dispose of the under or over applied overhead? Would it increase or decreases the company's gross margin? And by how much? I'm going to give you just a couple minutes here to kind of, do number one, and then we'll figure number two together. Okay, so to figure out what really got applied, we take the actual overhead direct labor hours times the overhead rate. So 11,005 times the overhead rate of 1820, sorry guys, is 2093. So the actual costs were 215. If we applied 2093, we've underapplied by 5,700. The actual costs were greater than what we applied. Assume the company's underapplied or overapplied is close to cost of goods sold. What would be the journal entry? Well, we would increase our cost of goods sold now by 5,700 which means there's less income. So it would reduce our gross margin by 5,700. Okay. Harwood uses a job order costing system that applies overhead cost to jobs based on machine hours. It got an overhead rate of $240 per machine hour. And we based that formula on 192,000 of total overhead with estimated machine hour activity of 80,000. But say the company works only 75,000 machine hours and incurs the following cost in the manufacturing overhead and work in process accounts. So we need to figure out how much overhead would we have applied. 75 hours, 1,000 times 240, right? So 75,000 times 240 means we would apply 180,000 here. Okay. So all of our manufacturing costs are shown, but we applied 180, which got added to our product, our job. So we have 60, 99, 150, 157, 187, should be 188 of actual costs. I'm thinking, let me just try it again, 60.
That's what I got.
Okay. Then if we applied 180, that means we under applied 8,000, right? Would y'all agree with me? How's it 4,000? $29, $69, 101, 108.
I get 188.
Obviously, I screwed up numbers somewhere when I went and processed this. So we'll assume our cost of goods sold needs to increase 8,000. Okay, and our manufacturing overhead, we will credit it to zero it out. But our costs now are more expensive or higher. I apologize. I must have plugged another number in to get our numbers. Explain why the manufacturing overhead was underapplied or overapplied. Well, we estimated realistically, the best answer in this one is our actual hours were only 75,000 hours, where they were estimating it at 80. So it makes sense why we were off. Okay. Okay, now let's look at homework. Okay. And for those of you who are watching this on a recording, I hope this has been helpful.